Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourself, Banking and General Knowledge, etc. Today I will discuss group discussion topics related to the internal promotion bank examination for banks. Welcome to part 4 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topic. First, impact of fintech companies on traditional banking. Second, artificial intelligence and machine learning in banking, opportunities and challenges. Impact of fintech companies on traditional banking. Emergence of fintech companies has significantly transformed the financial landscape worldwide, and India is no exception. Fintech or financial technology refers to the companies leveraging digital platforms, data analytics, AI, and blockchain to provide financial services faster, cheaper, and more efficiently than traditional banks. Fintech innovations span payments, lending, insurance, wealth management, robo-advisory, and peer-to-peer services. While traditional banks continue to hold the bulk of assets and deposits, fintech companies have disrupted customer expectations, competition, and operational models. The impact of fintech on traditional banking is multidimensional, with both positive and negative consequences, making it a crucial topic for bank promotion examinations, group discussions, and strategic planning. Positive impacts and advantages of fintech, pros and arguments for. Fintech companies bring several advantages to the financial ecosystem, influencing traditional banking in meaningful ways. First, increased financial inclusion. Fintechs have leveraged mobile technology, UPI platforms, digital wallets, and microlending solutions to reach unbanked and underbanked populations in rural and semi-urban areas. By reducing dependence on physical branches, fintechs complements banks in achieving greater financial penetration. Second, innovation and improved customer experience. Fintechs are highly customer centric. They offer seamless digital onboarding, instant payments, AI based customer support, and intuitive apps. This pushes traditional banks to modernize, enhance service quality, and adopt innovative solutions. Third, lower transaction costs and efficiency. Automated processes, minimal paperwork, and digital interfaces allow fintechs to deliver services at lower costs. Banks can benefit indirectly by collaborating with fintechs to reduce operational expenses. 4. Faster credit delivery and risk assessment. Fintechs usually use alternative data, AI, and machine learning to assess creditworthiness quickly. Small ticket loans, BNPL, buy now pay later products, and instant personal loans are processed within minutes, offering convenience that traditional banks often struggle to match. Fifth, encouragement for digital transformation. The competition from fintech compels traditional banks to invest in digital banking platforms, mobile apps, UPI integration, and real-time payments. This modernization benefits both banks and their customers. 6. Collaboration opportunities. Banks increasingly collaborate with fintech startups to offer co-branded services, APIs, and white label solutions. Such partnerships allow banks to leverage fintech agility without compromising regulatory compliance. 7. Enhanced data-driven decision making. Fintechs rely on big data and analytics and AI, helping traditional banks adopt more robust risk management, personalized product offerings, and marketing strategies. Negative impacts and challenges, cons and arguments against. While fintech companies introduce innovation and efficiency, they also pose challenges and risks to traditional banks. First, increased competition and pressure on margins. Fintechs offer low cost, fast, and flexible alternatives for payments, lending, and wealth management, eroding banks' market share in retail and small ticket segments. This forces banks to lower fees, invest heavily in technology, and potentially reduce profitability. Disintermediation risk. Fintech platforms allow customers to bypass bank entirely for transactions, lending, or investment services. This reduces banks' direct customer interactions and deposits, affecting traditional revenue models. Third, regulatory and compliance challenges. Fintechs often operate in a gray area of regulation. Traditional banks face stricter compliance and reporting norms, which can place them at a cost disadvantage compared to agile fintechs. cybersecurity and operational risk. Collaboration with fintechs increases exposure to cyber threats, data breaches, and third-party failures. Banks must heavily inse- must banks must invest heavily in secure integration and monitoring to protect customer data. Fifth, talent and resource strain. To compete with fintech agility, banks need skilled professionals in AI, analytics, digital platforms, and UX design. Recruiting and training such talent is costly and time consuming. Six, cultural resistance within banks. Traditional banks have offered hierarchical, bureaucratic structures. Integrating fintech solutions or adopting agile practices can meet resistance, slowing innovation. Arguments in favor of fintech's impact on banks. First, catalyst for modernization. Fintech disruption encourages banks to modernize legacy systems, adopt digital first strategies, and improve customer centric services. This strengthens the banking sector overall. Second, opportunity for partnerships. Banks can collaborate with fintechs to co develop products, enter new markets, and enhance service delivery, leveraging fintech agility while maintaining regulatory compliance. Third, promotion of financial inclusion. By targeting underserved populations and offering microloans, fintechs extend banking reach indirectly, supporting national financial inclusion objectives. Fourth, drives operational efficiency. Fintech-inspired automation, AI, and analytics help banks reduce manual processes, errors, and turnaround time, enhancing profitability and service quality. Arguments against fintech's influence. First, threat to traditional revenue streams. Payment processing, small ticket lending, and investment services are increasingly moving to fintech platforms, limiting banks' growth in these areas. Second, risk of dependency on third parties. Banks partnering with fintechs rely on external systems for critical services, which can lead to operational disruptions or reputational damage in case of failures. Third, cybersecurity and privacy concerns. Fintech integration introduces new vulnerabilities, and banks must invest substantially in risk mitigation, which can offset cost advantages. Fourth, customer loyalty challenges. Fintech users often have minimal emotional connection to banks. Switching costs are low, making it harder for banks to maintain long term relationships. Balanced comparison. How fintech and banks interact. The relationship between fintech companies and traditional banks is not purely competitive. It is increasingly collaborative with complementary strengths. First, agility versus scale. Fintechs are agile, innovative, and customer centric but lack the extensive branch network, deposits, and regulatory expertise of banks. Banks offer scale, trust, and financial security that fintechs cannot match. Second, digital first versus trust first. Fintechs attract tech savvy urban users while banks retain older risk averse and rural customers. Combining digital platforms with banking credibility is key for growth. Third, revenue versus inclusion. Fintechs focus on profitable niches and high volume digital transactions. Banks maintain priority sector lending, government schemes, and inclusive financial initiatives. Both models complement each other in serving in broader economy. Fourth, risk management. Banks are heavily regulated and have strong risk management frameworks. Fintechs bring advanced data, analytics, and AI capabilities. Collaboration enhances the overall risk management ecosystem. Fifth, customer experience. Fintechs set high benchmark for user experience, forcing banks to innovate and improve service standards. Customers benefit from this competitive pressure. Conclusion. A. The impact of fintech companies on traditional banking is profound, reshaping the financial services landscape in India and globally. Fintechs introduce speed and efficiency, customer centric innovation, and expanded financial inclusion, compelling traditional banks to modernize and innovate. At the same time, they present challenges such as increased competition, cybersecurity risks, margin pressures, and operational dependency. B. The future of banking will likely be defined by collaboration rather than pure competition. Traditional banks that embrace digital transformation, Partner with fintechs, leverage technology, and retain their core strengths of trust, scale, and regulatory expertise are poised to thrive. Conversely, fintech companies that comply with regulations, build customer trust, and integrate with the banking ecosystem can grow sustainably. C. Ultimately, the integration of fintech agility with traditional banking reliability creates a robust, inclusive, and efficient financial ecosystem. Customers benefit from innovation, convenience, and trust, while banks enhance profitability, operational efficiency, and long term resilience. Fintech is not a threat to traditional banking, it is a catalyst for modernization and sustainable growth in financial sector. Artificial intelligence and machine learning in banking, opportunities and challenges. Artificial intelligence, AI, and machine learning (ML) have emerged as transformating forces in modern banking. These technologies leverage vast amounts of data to automate processes, predict customer behavior, detect fraud, and personalize services. From customer onboarding to credit assessment, fraud detection, robo advisory, and compliance, AI and ML are redefining banking operations, risk management, and customer engagement. While the adoption of AI ML presents immense opportunities, it also comes with challenges and risks that banks must navigate carefully. Understanding both the advantages and limitations of AI and ML is essential for a balanced perspective on the future of banking. Opportunities and positive impacts, pros and arguments for AI and ML in banking. First, enhance customer experience. AI-driven chatbots, virtual assistants, and personalized recommendations improve customer interaction by providing 24/7 support, quick query resolution, and product suggestions tailored to individual needs. Machine learning algorithms can analyze customer behavior and offer relevant services, creating a highly personalized banking experience. Second, improved risk management and fraud detection. ML models can detect anomalies, unusual transaction patterns, or potential fraudulent activities in real time. AI enhances predictive capabilities for credit risk, market risk, and operational risk, enabling proactive measures and minimizing losses. Third, faster and more accurate decision making. AI and ML algorithm process massive data sets quickly, allowing banks to make informed decisions on loan approvals, investment strategies, and portfolio management. This reduces human bias and increases efficiency compared to traditional manual analysis. Fourth, automation of repetitive tasks. Routine tasks such as KYC verification, document processing, compliance checks, and data entry can be automated with AI. This reduces operational costs, minimizes errors, and allows employees to focus on strategic functions. Cost efficiency and operational savings. By automating processes and reducing manual intervention, banks can significantly cut operational expenses. AI-driven solutions optimize staffing, reduce processing times, and enhance resource allocation. Six, predictive analysis for business growth. Machine learning models can forecast customer needs, market trends, and demand for banking products. Banks can proactively offer loans, investment plans, and personalized services, improving customer retention and revenue. 7. Financial inclusion and accessibility. AI-powered credit scoring using alternative data can sources can assess the creditworthiness of underserved populations lacking formal financial history. This expands access to loans and banking services for rural and low-income customers. Sorry. Enhanced compliance and regulatory adherence. AI helps banks monitor transactions, detect suspicious activity, and comply with AML, KYC, and other regulatory norms efficiently. Automated reporting reduces human error and ensures timely submission of regulatory filings. Challenges and negative impacts, cons and arguments against AI and ML in banking. Despite the potential benefits, integrating AI and ML into banking operations comes with significant challenges. First, high implementation costs. Deploying AI ML system requires substantial investment in technology, infrastructure, skilled personnel, and continuous model updates. Small and mid-sized banks may find these costs prohibitive. Second, data privacy and cybersecurity risks. AI and ML rely on large volumes of sensitive customer data. Any data breach, misuse, or a hacking attempt can compromise privacy, erode trust, and lead to legal consequences. Third, algorithmic bias and fairness issues. Machine learning models can inherit biases from historical data, potentially leading to unfair lending decisions, discrimination, or inclusion to certain customer groups. Continuous monitoring is required to ensure ethical outcomes. Fourth, job displacement concerns. Automation of tasks through AI may reduce demand for certain roles in customer service, operations, and bank office functions, creating workforce challenges and resistance within banks. Fifth, dependence on data quality. AI and ML systems are only effective as the data they are trained on. Poor quality, incomplete, or outdated data can lead to inaccurate predictions, wrong decisions, and operational risks. Regulatory uncertainty. AI in banking is still an evolving field, and regulatory frameworks are not fully mature. Banks face challenges in ensuring compliance with changing regulations related to AI, data protection, and algorithmic accountability. 7. Systemic risks and over-reliance. Over-reliance on AI/ML may reduce human oversight, potentially leading to systemic errors if algorithms fail, models are misapplied, or edge cases are not handled properly. 7. 8. Integration challenges with legacy systems. Many banks operate on legacy infrastructure, making integration of AI and ML solutions complex, time consuming, and prone to operational disruption. Arguments in favor of AI and ML adoption. Competitive advantage. Banks leveraging AI and ML can gain a competitive edge by offering superior customer service, faster loan processing, and innovative products to compared to traditional banks relying solely on manual processes. Second, strategic decision making. AI provides actionable insights from complex datasets, supporting strategic decisions in risk management, investment planning, and market expansion. Third, efficiency and productivity gains. Automation and predictive analytics enable faster execution and fewer errors and better resource utilization, leading to long-term operational efficiency. Fourth, financial inclusion. AI-powered credit assessment and digital platforms bring banking services to previously underserved populations, supporting national financial inclusion objectives. Arguments against over-reliance on AI and ML. First, risk of algorithmic failures. Over-dependence on AI models may lead to errors in loan approvals, fraud detection, or investment recommendations if the models are poorly designed or trained on biased data. Second, human touch and customer relationships. Excessive automation may reduce human interaction, impacting relationship banking, trust, and customer loyalty, especially among older or rural populations. Third, ethical and accountability issues. Decisions made by AI can be opaque, creating accountability challenges. Customers feel affected by algorithmic errors may not have clear recourse. Fourth, cost benefit imbalance for smaller banks. For smaller banks, the high cost of AI adoption may not immediately translate into significant benefits, creating strategic and financial risks. Balanced evaluation. AI and ML in banking offer a paradigm shift paradigm shift in efficiency, customer experience, and risk management. Their adoption must be balanced with caution and oversight. A. Efficiency versus trust. AI enables faster operations and predictive insights, but banks must maintain a human oversight to build trust and manage complex cases. B. Innovation versus regulation. While AI drives innovation, banks must navigate regulatory frameworks, ethical considerations, and data protection laws. C. Cost versus benefit. Large banks with resources can implement AI at scale, reaping efficiency and revenue gains. Smaller banks must evaluate ROI carefully. D. Digital versus human banking. Hybrid approach combining AI ML driven analytics and automation with human customer support ensures optimal customer satisfaction and operational efficiency. The future of banking is likely to be AI augmented rather than AI dominated, where technology empowers employees and enhances services rather than replacing human judgment entirely. Conclusion. A. Artificial intelligence and machine learning are transforming banking by improving customer experience, enhancing risk management, enabling predictive insights, and supporting financial inclusion. The opportunities are vast, including faster loan approvals, reduced fraud, personalized services, and operational efficiency. However, challenges such as data privacy, algorithmic bias, cybersecurity risk, job displacement, and high implementation costs require careful management. B. A balanced approach is essential. Banks must integrate AI and ML through thoughtfully complementing human expertise, strengthening cybersecurity, ensuring ethical use of data, and maintaining regulatory compliance. Collaboration between banks, regulators, and technology providers is critical for sustainable and responsible AI adoption. C. Ultimately, AI and ML are catalysts for modernization and growth in banking, but their success depends on combining technological innovation with human judgment, ethical practices, and customer centric strategies. Banks that achieve this balance will lead the industry, deliver superior services, and remain resilient in an increasingly digital financial ecosystem. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.